Hey, what's going on, guys? Welcome to this video. Hope you guys are doing good today. What is up? I missed you guys. It's been a little while here. I just felt like putting together some little video. And in this video, I'm going to talk to you about something that I find interesting and relevant to my trading. This might be a bit of an advanced intermediate type of video. So if you're a beginner trader, you might not really understand what I'm getting at in this video here, but you might still gain something out of it here. So I'm not going to talk about something very complicated, but something more on the logical side, and I want to kind of explain to you my view on one thing. So if you enjoy this content, leave a like on the video. We're actually testing out a new camera here, and this should be in 1080p 60 frames per second. Okay, as you can see, I'm wearing this red hoodie. Now I would never wear this while trading. I'll tell you why. Because red is an aggressive color. I'd be putting out aggressive energy, meaning that I'm more likely to take an aggressive, irrational trade. Maybe that's a little crazy, but okay, so this is my sort of philosophy here. You may agree with it or you may not, and I'd love to hear your thoughts on it as well. It's basically this. So the more money being thrown around in a market, the more participation there is in a market at any given moment, the higher the odds that an experienced trader has an edge. As you know, in a market, not everybody is making money at the same time. If someone's making money, someone else is losing money on the other side. Now, it might not be a human, it might just be a liquidity provider that instantly hedged themselves as soon as they got filled on the opposite side of your trade, for example. But at the end of the day, there's always two participants to a trade. You need to understand that. My philosophy is that the more participation there is in a market, the higher the odds that the traders who pick tactical locations are making money. The higher the odds that traders who have experience trading these markets have an edge. So their edge shines when there's more participation in the market. There's more dumb money floating around, taking the opposite side of your trade, getting stuck buying the top, getting stuck selling the bottom. You see where I'm getting at here? Okay, so the opposite of this here is that when the market is, slow, low participation, that essentially translates to less opportunity, less volatility, low participation markets, right? And that is why I think for certain styles of trading, I think it's important to actually know when to not trade, when the market is too slow for whatever it is that you're trying to do. For example, scalping, there is a sweet spot for how the market needs to be moving for what I do to work properly, and I think this applies to anything, any method. Right now we're looking at a recording on my screen here, and you can see how the bid and ask is moving around. This is the movement of the market. Now if I fast forward it to a different moment in the day, you can see that the market is now moving differently. It's moving a lot more. There's more volatility, there's more activity, there's more orders being filled, there's more volume, right? That's a different market environment than the one we were previously looking at. Okay, so how you choose your strategy to trade is going to largely depend on the kind of market you're in. And I would honestly say, well, this is from my experience, is that there is certain market environments that really, if you're a scalper, you shouldn't even trade it at all. Okay, and it's those low participation environments, really, where there's nothing going on. The market's either stuck in the middle of a range, and it's already traded the upper extreme, it's already traded the lower extreme, and honestly, you're better off just waiting for something to happen rather than looking for a trade right now where you currently are. Okay, that's kind of where I stand when it comes to that. Now, in regards to the next point here, this is a typical scenario that happens. You have a certain plan for a trade, you trade it once, you get stopped out, or maybe you scratched it. Okay, then you trade it again, you get stopped out again, or you scratched it again. That's two in a row now, the same trade. Okay, now if you're going to try that trade a third time at this point, you have to have a really good reason. Okay, so this is kind of the problem that a lot of traders have, myself included, is that when you're wrong on a trade, for example, the market stops you out, and then, for example, right after you get stopped out, maybe you got stopped out on a top tick or a bottom tick, which is really no fun. Actually, it feels like you're being personally attacked. So the market has this way of playing with you, and you need to learn how to not give into that, and actually how to catch yourself before you engage in some kind of activity, which I would call fighting. So you don't want to be the one fighting the market. Remember this one thing: the market is your friend, okay? And if you're gonna make money today, it's because you're letting the market tell you what to do, not putting your opinion onto the market, which is the tendency that seems to happen, right? So you get stopped out 2 times in a row, maybe 3 times in a row on a trade. Now you're fired up. You want to fight the market, okay? It's that moment there where you got to catch yourself and you got to say, all right, I'm going to take a step back. I can clearly see what I'm doing is not working. I'm going to wait it out, maybe take some fresh air, walk around a bit, stretch out. You know, you have to give yourself a clear-cut rule there that says if you haven't hit your risk window on the day, you're still good to trade. You should probably just wait it out another 15 minutes, another 10, 15 minutes or so, or basically just wait for something to happen and change around your plan as necessary, right? So if you're short-term trading, you can have many plans occurring over the course of the day, and you got to be quick to scratch your plan if the thing's not working out, right? So getting back to what we discussed in this video, rule number one, trade in markets that have high participation. You don't want to get involved in a market that has low participation. Higher participation means more dumb money floating around, more money in general floating around. The higher the odds you get the fill you're looking for, and the condition will be right for whatever it is you're trying to do. Remember, whatever method you're applying, it is working in an environment. If the environment is not right for what you're trying to apply, then good luck, because it's probably not going to work. You're fighting what's happening now if you're trying to trade a market or a strategy that you have in your head instead. So today was the FOMC, and I would say for the large part of today's session, that being the morning until about 11:30, there was nice participation in the market. Nice participation means good volume, good movements, good rotations, clear balance areas, clear imbalances. It all ties into that, what I'm calling it right now as a high participation market. If you want to know what a low participation market is, well, look right at your screen. If you see that your dome is barely moving around, well, that's clearly a market that is in the low participation mode, and I would not trade that at all. You can develop a way of simply analyzing what's going on. If you see your dome is moving around 5 handles around, nice rotations, then you can probably say, all right, this market's pretty good to trade. Where am I putting my orders? If your market's not even moving around 1 or 2 or 3 points, you should probably step away from that market right away, or wait for something to happen, wait for the condition to change. That's sort of where I'm at, guys. I would love to hear your thoughts about it in the comments. To end the video now, I'm going to show you one trade that I really enjoyed from today that I found was really interesting. So here we go. All right, so we're going to take a look at a certain trade here. I'm going to make myself even smaller and throw myself in the corner up here, all right? This is recording my screen today. It was the FOMC, so you can see here it's 2:17 p.m. at this point. Okay, the market is coming off somewhat of a bullish imbalance higher. We're coming off a bit of an up move here. So we're going to watch the trading at this point here. And you're going to see where I have my order, and you're going to see how this order fills and then what happens afterwards. I just found it interesting to some degree. So let's watch this video now for the next minute or so. If you don't know what's going on, then unfortunately I can't help you there. So the market last traded price is around 918, 917 now. So here we go, 16, 15. We see some good selling coming in. We're coming off an up move up to that 23 handle. Just some light consolidation more or less here. Now watch very closely what happens. Okay, we're still trading 17s. All right, 18 offers, 18 bids. Now watch. Market's relatively slow. There we go. That's what we wanted to see. All right, so there was a big block of selling that somehow hit the market at that point and managed to fill my order, okay, in a split second. We can watch that again. I just thought this was an interesting trade because it all happened so fast, right? So I'm bidded down at 912. I got filled on the order there on the sweep. Now look at this market here. Trades 13, bid very briefly, then 14, then 15. Now we're bidded at 15 here. Now 16 on an offer now. 15, now 14 bid. Okay, so that's an example of a trade where I got filled. I would consider that at a very unfair price. Like, someone definitely got stopped out there and was really mad at that point. And unfortunately, I took the other side of their trade. And as you can see there, the market moves there. I trailed the stop pretty quickly. That was a very easy trade. I just wanted to share that trade with you guys because I thought it was interesting. Now, you know, you could argue that maybe I trailed my stop close, but honestly, I just wanted to get paid here. I think I could have, you know, locked in another couple of points here on this trade. What I would say is, as long as your risk to reward is mathematically good, then don't be a dick for a tick at the end of the story. In that kind of market condition, you know, you want to get paid sooner than you let the market come against you, right? As fast as the market moves in your favor, it can certainly move against you. And because of how fast I received the fill, This is the type of trade that if the market would come back to that price again, that is an instant scratch for me. Because of how fast that fill occurred, the chances that that price will still be good the second time is much less likely anyways. Maybe I'm going a little bit too much detailed here. All right, guys, so I'm going to leave it there for today. If you enjoyed this content, smash like, subscribe, all that stuff, and I'll catch you soon. Take care. Bye.